Can you actually buy a house with no money out of pocket? I'm sure you've seen those videos, and the answer is sort of. But should you? What's the catch? And how do the other options compare? In this video, let's talk about 17 ways you can finance a real estate rental property purchase. None of this is financial advice. I am not endorsing any specific method. I am not a lender. I am just a very part-time real estate investor who has used some of these methods and recently went down a rabbit hole on what to do next with my next investment. I hope this video gives you a solid overview of all the options that are available to you, some of the pros and cons, and help you arrive on the right decision for your situation. The first one is a straightforward conventional mortgage from a traditional bank or mortgage lender. You'd pay a down payment, typically 10 to 20%, and anything less than 20%, you would then have to pay additional private mortgage insurance or PMI. The other 80%, or however much you didn't pay as a down payment, will be financed by the lender, and you'd pay them back every month, usually as a fixed interest over the span of, say, 30 years. The biggest pro is that the interest rates for these traditional mortgages are actually quite reasonable. I know it's kind of a weird thing to say right now when the interest rates are going up, but compared to all your other investment options, these traditional mortgages have much lower interest rates. It's a pretty straightforward process, and most sellers and agents would be familiar with this when they see it on your offer. Now for cons, you can't use this to buy straight up rental property. You could A, use this for your primary residence and then rent out like an ADU or one of the rooms in an Airbnb situation, or B, you can buy something that's 2 to 4 units. Anything 4 units and below still falls in line for this kind of mortgage. Or C would be to buy a second home or vacation home in a faraway place for the purpose of Airbnb-ing it. It just needs to be far enough away to count as a vacation home, and you do also need to intend to at least use it as a vacation home at some point. And if you're thinking, how does the bank even know if you are vacationing there or what you're going to do with this Airbnb? They'll know when you apply for the next loan, and there's like a Schedule C or Schedule E, depending on how you choose to do it, that reflects income from this property that you have a mortgage on. Personally, from speaking to my lender, it is totally cool to do that, to have a vacation home that you do rent out for part of the year. It might just take a little bit of explaining the next time you apply for a loan. Rules may be different everywhere though, so check with your own loan officer. The other big con is that you need to have income and a good credit history for you to be able to qualify for one of these mortgages. You need to show your tax returns, your recent pay stubs. They'll pull your credit and they'll look at your overall debt to income ratio. For most lenders, they want this ratio to be under 36 to 40% or so, and therefore it may be difficult for someone who has fluctuating income to show that they have consistent income in the past years, or you just got a raise and you have more income now and you can buy a more expensive house, but it doesn't show up yet in your last year's tax return, or if you're younger and you don't really have enough credit history to pull from. Number 2 is an FHA loan, or Federal Housing Administration backed loan. The main pro is that you can put down as little as 3.5% as a down payment, but the con is that it needs to be a primary residence. You can purchase something that's up to 4 units and just live in one of the units and rent out the rest, like in a house hacking situation. And for the primary residence criteria, you basically need to live there for at least a year and then have a reason for moving out, like an expanding family or a new job that requires you to relocate to a different place. So another way to use this is to buy a single family home that you just live in like normal, and then when you move out, then turn it to a rental property. Number 3 is a VA loan, which I think of as the military version of an FHA loan. There are better terms because you can put 0% down. There's no private mortgage insurance, even if your down payment is less than 20%. And there's a cap on the closing cost. All great things. The con, as you would have guessed, is very similar to FHA loans. You have to live there as a primary residence, and you have to live there for at least a year. And of course, you have to have military benefits for you to qualify. Additionally, if you paid 0 down payment and you need to sell the house, for example, all of a sudden, and the house value has either gone down or not risen by much, then factoring closing costs and paying agent commissions, you might end up needing to pay into the deal to sell the house. Moving on to number 4, an investment property loan. This type of loan works to, again, up to 4 units of multifamily. And unlike the first 3 options, you can use it to buy like a straight up rental property that you don't live in. Similar to a regular mortgage, you are still using your personal income and your tax returns and credit to qualify for this kind of a loan. The main difference with a traditional mortgage is that the interest rates for an investment property loan is higher, and there is a minimum of at least 20% down payment. Between the traditional mortgage, second home mortgage, and investment property loans, there's also a cap of 10 Fannie Mae or Freddie Mac loans that you can get under your personal name. Your debt to income ratio is also still in play here, so you can see how you can quickly run into like a maximum amount if you're trying to scale exclusively using mortgages. Option 5 is a DSCR loan, which stands for Debt Service Coverage Ratio. Instead of using your income to qualify, which, like we said, depending on how much you're scaling, you will run into that 40% debt to income ratio cap, or the 10 maximum Fannie Mae loans. A DSCR loan looks at the income that the property is going to make to determine how much you can borrow. It's kind of like a business loan. That is the main benefit, to take out your income and your tax returns out of the equation and focus on how much money this deal is going to make to qualify. The downside is that usually interest rates are higher for DSCR loans compared to standard mortgages because of the higher risk to the lender. And also, assuming you're considering this option because you have crossed over the 40% mark on the debt to income ratio, now is a good reminder to do a little risk assessment. How much leverage are you actually comfortable with? Number 6 is a HELOC, or home equity line of credit, which is a revolving line of credit that uses your home equity as collateral. Basically a second mortgage on a house. This one has some really good use cases, but I kind of went back and forth on whether to include it because it feels like I'm handing over a really sharp knife, not knowing whether it's going into the right hands. A HELOC can be set up with a bank, and then you just pull money when you need it. The interest is only on the money that you do pull out, so there is some benefit to that flexibility and only paying interest on what you actually need, ideally for something that's quite short term. You could use that money for remodeling a rental, or you can use it towards the down payment of a next house. Not all lenders will allow the second type of usage, especially after all that happened around the 2008 crash, so make sure you double check with your bank. Some very important downsides to HELOCs are that A, the interest rates are going to be higher, and B, if you're thinking of using the HELOC as a down payment to the next house, are you now over-leveraged, carrying 3 mortgages for 2 houses? What if home prices started to fall and you happen to need to sell immediately, but now what the house is worth is now under the amount you owe? What if you lose your job and you can't service all 3 loans on these houses? Just be careful with the math here and try to think through some worst-case scenarios. Number 7 is cash-out refinance. Similar to a HELOC, you're taking advantage of equity that you have built up in a different property, and as you refinance that whole house, you get to increase the loan amount and take out that difference in cash. The pro is obviously accessing the equity that's just sitting there and not doing anything, not generating returns. The con is that a lot of us who currently have property are sitting on this amazing interest rates that's below 3%. How useful will this chunk of cash be in generating returns versus how much are you trading off by getting into a higher interest rate? And then comparing that to a HELOC, where you keep your original mortgage and just take out a smaller chunk, albeit at a higher interest rate than a cash out refinance. Which one is better? This is mostly algebra, and Google Sheets is your friend. Moving on to number 8, a personal loan is an unsecured loan that you can get from a bank, and it can be used for various purposes, including buying a house. Interest rates are really high, like 2 digits at the time of filming, and the lending process can take time. There's credit checks, there's like income verification, all the same stuff that you would need to get a mortgage. There are some alternatives to this outside of classic banks, and that leads us to number 9, private money lenders. Now, this can be family or friends or organizations or hedge funds or just individual investors. And sometimes the other name for this is hard money. The pro is that these can be obviously faster and easier than going through a bank to get a loan. And sometimes you may already have friends and family who are interested in what you're doing. They've heard you talk about your investing, and they just want to be part of it as a silent investor. This could be one way to structure that partnership, where they just give you the capital in exchange for a very stable interest return. And like many other YouTubers have said, yeah, if someone else is paying for the down payment, you do technically have $0 out of pocket. The con to private money lending is usually in the terms. Like, it could be interest only for X number of years and then it balloons, aka all of it is due at like 5 years. Or the interest rate could be higher, or you're leveraging relationships. I have personally collaborated with others in this way, both as the lending side and also as the person taking the money side, which sounds really wrong. But very luckily, in all of those situations, they were amazing partnerships that everyone got what they needed out of it. That said, I can see how this can go wrong in 100 different ways, and you need everybody to be on the same page for this to work. Either way, there's some level of negotiation, some level of trying to figure out what is a win-win for everyone involved. Number 10 is bringing in partners and giving them equity in the deal. So instead of treating your family or friend as a lender, you're bringing them in as partners. They may be bringing in the upfront capital in exchange for like a percentage of equity in the house or percentage of the cash flow, etc. There are infinite ways to structure this. You could go 50-50. They could be bringing all the money and you bring all the work and the deals. Or maybe it's 80-20 until their initial down payment investment is paid back, and then you go 50-50. You can split up cash flow differently than equity, than expenses. Whatever it is, just make sure it's a win-win for everyone. Have it in writing and probably double check with a CPA to make sure it's a smart way to split. Number 11 is owner financing or seller financing. The property seller acts as the lender or the bank in this case. You guys get together, you sign a note that says you will pay them X dollars over Y number of years with whatever interest rate you guys decide on and whatever down payment. The pros is that this could potentially be faster, just working directly with the seller, bypassing the bank, and the terms could be better. And this is where sometimes people give examples of how they put no money down and the entire thing is financed by the owner. The main con, in single family at least, is that the pool of sellers who are willing to do this or interested in doing this is inherently going to be smaller. Because if you think about it, if a seller can list the traditional way on the regular MLS and receive multiple offers all above asking price on the first day, why wouldn't they just do that? There would be no need for them to go through this riskier route where the buyer might flake or they might stop making payments. And even though you can go through foreclosure and get your property back, it is a hassle and a certain level of risk. So for this method to work, you're basically looking for a very motivated seller, a seller that could be in distress. Maybe their house is underwater and they would have to cut a check to sell the house in the traditional way. Or maybe they have tried already listing the standard way and they're not getting the price they want. And you come in offering their desired price in exchange for like a lower interest rate, for example, where they finance. As you can see, this really just depends on the seller's situation. And if they're open to this, you have to figure out whether the math actually works in your favor. Semi-related is number 12, subject to financing. Subject to financing is basically when you take over the title of the house and the payments. Like the house is now in your name, but the mortgage is still in the seller's name. The seller keeps their original mortgage with the bank, but you're making the payments. The appeal is that there are so many homes that have these amazing interest rates that are 3% or lower, and wouldn't it be so much nicer to keep that low payment monthly instead of you trying to get a new mortgage with terms that are like in the 6 or 7% range? The other often advertised benefit to using this approach is that you don't need credit, you don't need a specific income, you don't need to show anyone your tax returns. This is kind of a thing that you work out with the seller and you bypass the bank. A few potential issues to think through though. First of all, why would someone want to do this? Not like a snarky, well, why would somebody want to do that? But like a healthy skepticism of the owner's motivations. Because the target is highly motivated sellers. They're either not getting the results they want in a traditional listing, or they desperately want out for some other reason. That reason could be a personal issue, but it also could be a property issue, right? Maybe this is an Airbnb and this person has some insider information where the regulations are changing next year and they want to sell it before then. Or maybe the flood map is changing and the insurance is set to double next year. How do you make sure that your due diligence process is going to uncover everything that you need to know about the place before committing? Secondly, you need to get these leads from somewhere. You're either purchasing a list or you're working with a wholesaler who is going to charge you a fee. Or you're manually spending time looking at what listings are about to expire and then keeping track of them and then reaching out after. And then thirdly, how much time will you invest in explaining subject to the agent or the seller? How successful will you be overall? How many no's do you need before you get a yes? And then lastly, a few post-purchase risks. And there may very well be answers and ways to mitigate these. I'm definitely not an expert, but just something you should think about if you want to pursue this route. The sub-to arrangement means that the mortgage or loan is still with the original bank with the original seller's name on it. So what if the seller dies? Will the bank then use the due on sale clause? What if the seller files for bankruptcy? Does the property, which is currently in your title, does that go to the trustee? And what are your exit options if the loan is still in effect, but you want to sell it, you want to refinance it, you want to draw out the equity of the house, etc.? Overall, this could be a very useful tool, just a lot of fine print that you need to go through, and it's definitely less regulated than the traditional mortgages. So ask yourself if you A, understand, and B, are comfortable with the trade-offs. As with everything else that I'm sharing in this video, there is definitely not just one right answer for every circumstance. And I do want you to stay open-minded to all the possibilities and find that healthy balance between straight up getting scammed or not understanding the work involved versus being way too skeptical and closing doors to even learning about potential things you could do that are beneficial. All right, switching gears to number 13. Borrowing against your 401k or 403b. It's not really a true loan because there is no credit pull, it doesn't even show up on your credit report. You're basically borrowing money from yourself or your future self. Not all work retirement plans allow this, so double check if this is the case for you. Usually there is a limit of up to $50,000 or half your assets, whichever is lower, and you usually have to repay it in about 5 years. The benefit is mainly that it is so accessible and it doesn't really hurt your credit, and any interest you pay, you're just paying to yourself. The downsides are that A, while the money is loaned out, it is obviously not in the 401k or 403b to be generating interest or growing, and B, the interest that you owe, which can be like 6% but fluctuates with the market, that is paid back using after-tax money. Remember that your 401k is normally pre-tax and you get taxed on the back end when you're retiring and taking money out. In contrast, this interest that you owe yourself is paid with after-tax money, and then it gets taxed again at the back end when you're retiring and withdrawing money. So you're essentially double taxed on that portion, and depending on your tax bracket, what the interest rate is, and how long you're having the loan for, this could be in the thousands. I think I could see the argument for this type of borrowing if that $50,000 that you take, for example, is going to generate better returns even with these tax implications, with purchasing real estate versus sitting in your 403b stock portfolio. Along similar lines with retirement money is number 14, self-directed IRAs. IRAs are, as you know, individual retirement accounts, and you can open these self-directed IRAs, and they can be traditional or Roth. And this self-directed IRA has more flexibility for investing in a range of different investment options like cryptocurrencies, precious metals, and for our discussion, real estate. The IRA can get a loan to purchase a rental property, and the mortgage is paid for by the IRA. Any rent that comes in and expenses that go out, they all stay within the IRA. Like, basically treat this IRA as a separate person that you're not even friends with at all. The magic of this is think about all the tax benefits that exist within an IRA account and how that compounds with a rental income generating asset that is appreciating and the loan is getting paid down. Like if you started with a self-directed Roth IRA holding just the down payment, in 30 years you could have this entirely paid down and appreciated house that has been cash flowing the whole time, and all of this exists within an IRA, which is tax-free. Now, let's talk about the downsides. Usually the brokerages or like the places where you can make a self-directed IRA, they have higher fees. And secondly, your house is under the IRA and not you. And there are very specific rules about how you or your family, with a long list of who counts as family, can interact with this property. You can't live there, you can't vacation there. No, you can't buy the college house for your kids to use when they go to college. You can't even work on it and do remodeling yourself. You have to pay somebody to do the painting, do the whatever. You can pretty much only do kind of the managing, but not use it. And lastly, it can be a little difficult to get a large enough sum of money within an IRA to invest in real estate. Remember, the IRA cap is $6,500 per year as of 2023. And so in order to get a big enough chunk of money, you'll need either A, taking advantage of when you leave a company, so like your 401k, 403b, 457b, or even your pension. When you leave a workplace, that has an opportunity to roll over into an IRA. Obviously, you'll have to weigh the pros and cons of, do I want to do that versus put that into like broad stock market index funds? Or B, leaving a company also includes like quitting or closing down a solopreneur venture. So if you had a solo 401k with that could roll into an IRA when you close that out. And C, if you're self-employed and actually make enough money, you have a higher cap to this IRA contribution because you are both employer and employee, and you could use the SEP IRA to build out a big chunk of money within an IRA faster. I feel like I said IRA so many times. Number 15 is a lot loan. And a lot loan is meant for buying a piece of land that you intend to build into this dream house, amazing vacation Airbnb, or you have a plot that is empty and you want to build a fourplex on it. You can apply for a lot loan very much like how you would apply for a regular mortgage through a bank. But because these are higher risk to the bank, usually the interest is higher, and not all banks even offer lot loans. Having a separate loan just for the land also introduces another application, another set of closing fees. However, for more unique custom build projects where you've like identified the location and then you want to get really involved with the design and the planning and choose who's the right person to build it, a lot loan is a good way to go. Following that, number 16 is a construction loan. This is common for when you already own the piece of land and you're financing the construction process. A construction loan is usually in two phases. There's the construction phase, and usually this is about a year where you're only paying interest and only on the amount that is actually taken out. So for example, your contractor sends an invoice to the title company for a $50,000 breaking ground or whatever. Then your title company sends this to you to approve. And once you've approved that, yep, this is my house, this is the stuff that they are actually doing, I approve this transaction, then the money gets drawn out from the bank under your construction loan. And now your loan is $50,000 and you start paying interest on that $50,000. Next month, say they order supplies for framing and they send another invoice through in the same process, and your loan starts to grow and grow throughout the whole process, and you start paying a little more interest month by month, up to a predefined cap, of course. At the end of this construction phase, then the whole thing gets wrapped into basically a standard mortgage with a fixed rate for 30 years, and the interest rates should be pretty similar to a traditional mortgage. And lastly, number 17 is cash. Using cash eliminates any sort of interest and financing paperwork, and if you're in a really competitive market, having a cash offer can really help you stand out amongst a bunch of different offers. The downside, of course, is could this chunk of money be generating better returns used in a different way? So instead of paying in cash for a $1 million house, could you finance 5 houses, $1 million each, but only paying a 20% down payment for each of them? And would that overall generate better returns despite paying interest? Also important to remember is that in like a rental property situation, your interest expense is tax deductible. I have friends who own this rental property outright, and they are actually paying way more in taxes than they would if they had a mortgage on the house, and they're looking at ways to cash out and refinance the thing just to deploy the equity somewhere else to make a better investment while reducing the tax burden on their current rental. There are so many more variations in financing a deal, and this is by no means a comprehensive list. You can combine different methods, there are rates and terms that you can negotiate in all of these methods, and there are probably ideas that I left out in the video. Please do share if you can think of any in the comments below so that we can all learn. I hope this high-level overview was helpful, and if so, give this a thumbs up. Thank you for watching, and I'll see you next time. Bye!